Welcome, options traders. I just wanted to post another technical indicator video here for everyone to help you with your technicals and to try and figure out which stocks may be ready for a breakout or which ones are looking relatively strong or relatively weak. Because, after all, everything is relative, and that's what matters most with investing. So how can you tell? Well, that's where the price relative indicator comes in. So let's take a look at some of the details. Price relative indicator, what it does is it compares the relative performance of one stock to an index, industry, sector, or even another stock. I've highlighted the word index because in probably almost all of the cases, that's what traders are going to look at. But you could make comparisons to other, again, industries or sectors. It is sometimes called the relative strength indicator and also abbreviated sometimes as RSI. But don't confuse that with relative strength index, which is really, when people talk about the RSI, that's probably what they're referring to. So I always call it the price relative indicator, just to make sure there's no confusion. So the idea behind the price relative indicator is very similar to pairs trading. And many of you have maybe even used this or at least heard about it. And what pairs trading is, it's a style of trading where you're going to buy and short two different stocks that are usually in the same industry that are highly correlated, which just means that they tend to rise together and also fall together. So for example, maybe you buy Home Depot and short Lowe's. And to do this, you would have to do them in equal dollar amounts. But the idea is that you're long the one that you think will outperform and short the one that you think will underperform. And the interesting thing about this strategy is that as long as Home Depot increases more by a bigger percent or falls less than Lowe's, you will make money. So interestingly, you would not need Home Depot's price to rise. You just need it to outperform Lowe's. And that's the idea behind pairs trading. You could do the same thing with Coke and Pepsi, but you get the idea. You're just trying to find two highly correlated stocks. Well, money managers use similar comparisons between the stocks that they're investing in and a broad-based index, let's say the S&P 500, because after all, that's what they're hired to beat. Remember, about 90% of all fund managers, money managers, cannot beat the S&P 500. So that's usually their benchmark. So what they want to do is to say, well, are my stocks outperforming this benchmark? And when will it might be a likely point for them to turn? And that's where you can use the price relative indicator. So while it might sound fairly technical, this is probably the easiest calculation you will ever see in your life for any technical indicator. It is very simply the stock closing price divided by the index closing price, or whatever you're comparing it to. If you're comparing it to another stock, you would take the two stock closing prices. But for this example, I'm going to always assume we're looking at an index. So let's say that the stock is trading for 100, and our hypothetical index here, just for ease of numbers, let's say is trading at 1,000. The relative price is 10% or 0.10. And what's interesting about this is that this ratio remains the same as long as those proportions remain the same. So for example, if the stock is 100 and the index is 1,000, that's a ratio of 0.1. But what if the stock rises 10% and the index rises 10%? Now my stock is worth 110, the index is worth 1,100. But notice that the ratio doesn't change. It's still 0.1. What if the stock and the index both fell? And it doesn't matter which numbers we use, but let's just say they both fell 10%. My stock is now trading for 90. The index is worth 900. But still, 90 divided by 900 is 0.1. The ratio has not changed, and that's because the relative performance has stayed the same. The only time you're going to see changes in this price relative is when you get mixed signals. So for example, both might rise, but let's say the stock rises by a larger percent. So maybe the stock goes up 15% and is trading for 115, but the index has only gone up 10% and is trading for 1,100. Well, now 115 divided by 1,100 is about 10.5%, 0.105. So notice that my indicator has risen from 0.1 to 0.105. Why? Because my stock outperformed the index. That's not saying that the index went down. It's just saying that my stock performed better than the index. That's when we will see the indicator rise. Of course, we could see both of them fall. Maybe my stock falls 10% and is trading for 90, but the index falls 15% and is trading at 850. Well, if you take 90 divided by 850, you get 0.106, or about 10.6%. But again, I've risen. I've gone from 0.10 to 0.106, and that's because my stock outperformed the index. So when we're reading our chart here, understand that our ratio increases as long as our stock rises faster or falls slower. So again, for examples, let's say the stock rises 2%, but the index increases by 1%. That's still a relative outperform, and we'll see that indicator tick up. Also, maybe we'll see our stock fall 1%, but the index falls by a larger percent, maybe 2%. We will still get an increase in that reading because in relative terms, the stock outperformed. How does our indicator fall? Well, the ratio will decrease if the stock rises slower or falls faster. So let's say that our stock goes up 1%, but maybe the index rises 2%. In this case, we will see that ratio decline. But again, it's important to emphasize that doesn't mean that our stock price fell. It's just saying that the relative performance went down. We could also see the ratio decrease if our stock falls, let's say 2%, but the index falls by a smaller amount, let's say 1%. In this case, our stock underperformed the index, and therefore we would see a decrease in our indicator. So the most important thing to understand is that when you're looking at this price relative indicator, a rising line does not mean that your stock prices were necessarily rising. They were just outperforming the index. And conversely, a falling line does not mean that your stock price was falling. It could have been falling at a lower rate, in which case it's outperforming the index. So the idea is fairly simple. We're looking for times when the stock outperforms the market. And when we can identify moments where the stock outperforms the market, then what you're going to find is that this stock will probably lead or outperform during market strength. For some reason, this is the one that all the money managers and fund managers are watching. They are looking for it to outperform. It will also probably lag during the downturns. So yeah, we might see the S&P fall 5%, but you might only see the stock fall 3%. And when we finally do bounce out, these stocks will usually lead the rallies out of the bear markets. So those are some of the ideas that we're looking for by checking out the price relative indicator. So what are the signals? Well, we can do trend analysis, and like a lot of these indicators, we can also get what are called bullish and bearish divergences. So let's take a look at the calculation here, and then we'll go into the E-Trade platform and look at some examples. Okay, here's an Excel spreadsheet showing the prices of Amazon and the SPY. SPY is just a 1/10 index of the S&P 500, but it measures the S&P 500 index. I just like using it because it's smaller numbers here. But this is over the past 3 months. So let's say back on 7/2, Amazon closed over 1713. The S&P was 271.86. So if we take this 1713 figure divided by 271.86, we get 6.3. That is our price relative. In other words, Amazon's price is a little more than 6 times the level of the SPY. The next day, 7/3, take a look what happened. Amazon fell from 1713 down to 1694 almost. I'm highlighting that in red. The S&P also fell from 271.86 to 270.9. It's also in red. Both indexes fell. And we also see that our price relative fell from 6.3 to 6.25. Why did the price relative fall? Well, hopefully you know now it's because the change in Amazon was bigger than the change in the S&P. So here are the individual calculations. Amazon fell by 1.16%, but the S&P only fell by 0.35%. So in relative terms, Amazon underperformed, and that's why the index dropped from 6.3 to 6.25. Now here's another interesting example. Notice on the next day, both Amazon and the SPY increased. Amazon went from 1693 to 1699. S&P went from 270 to 273. And if we divide those out, we get 6.22. But it's a drop from the previous measurement at 6.25. Why did we fall to 6.22? Because even though both prices went up over here, Amazon only increased 0.34%, whereas the S&P increased 0.82%. So again, Amazon underperformed the S&P, and that's why we see a decrease in this indicator. Now let's take a look at 7.9. Amazon increased from 1710 to 1739, showing that in green. The S&P increased from 275 to 278. And if we divide those out, we get 6.26. Why did we increase from 6.21 on the previous closing to 6.26? This time, Amazon increased by a larger percentage. It went up about 1.7%, whereas the overall market went up about 1%. So in relative terms, Amazon outperformed the market, and that's why our indicator ticked up from 621 to 626. So the main point to see is that even though back here on 7.5, Amazon and the S&P increased, it led to a decrease in our indicator. But down here on 7.9, both numbers increased again, but this time we got an increase in the indicator. So you have to remember that you are always looking at the relative prices. And again, the importance of that is that our indicator is simply this list of numbers right here that you will see on your broker's platform, and it's going to look something like this. But too many times new traders will see it tick up and they'll say, oh, that means that the stock price was rising. Not necessarily so. Or down through here, they'll see it fall and they'll say that means that the stock price was falling. Not necessarily so. Both numbers could have been rising. So you just have to remember when you're using this indicator, you are looking at the relative prices between the two. Let's go over to the E-Trade platform and take a look at the relative price indicator. Click on Studies up here, all studies down below, and then over here we have our price relative. Click there, and you get to enter your ticker symbol. Again, it could be a sector, it could be an index, could be another stock. To keep the example the same, I'm going to use the SPY, and I can change the color here, and then let's choose Save. And down below is our price relative. Let's expand this so we can see it a little bit better. There we go. So now take a look at Amazon. You can see that the price relative over here right now is at about 6.7. Again, just meaning that Amazon's price is almost 7 times bigger than the value of the SPY. But take a look that the overall indicator has been rising quite strongly. What does this tell you? That Amazon overall, over the past year here, has been outperforming the markets. Now this is a little bit of an exception because it's been on such a long uptrend. But we also get a lot better signals when we see stocks that go through fluctuations where they're underperforming and overperforming. So one, for example, might be Home Depot. Let's take a look at Home Depot here and take a look at the price relative. And you'll see some interesting things. Notice at the peak, right up here, we hit some resistance somewhere around 0.73 or 0.74. Home Depot obviously has a much lower ratio here because its stock price, in this case, is about almost 75% the level of the S&P 500. But the point is that the overall market likes it at these ratios. And so if the overall S&P climbs 10%, this ratio will probably stay the same. That's one of the main reasons that you'll see this indicator have very definite levels of support and resistance. So you're not necessarily going to get this in the stock price chart. Why? Because if the level of the S&P increases, let's say 10%, so too will Home Depot's price. And so we might see that we get new resistance levels at, let's say, 220 or 230 sometime down the line. But what you might find is that that ratio stays the same, in which case you will get much stronger levels of support and resistance by looking at the relative ratios rather than the absolute prices of an individual stock. So this is one way to use the indicator. It's a little better if you could throw on a moving average. Unfortunately, the E-Trade platform does not let you put on a moving average, but I'd probably throw on a 100 or a 200-day moving average here to look for crossovers as well. But now the second thing you can look for is what are called bullish and bearish divergences. So here's a real good example. You can see that on the stock price chart, Home Depot was falling all through here. But if you look down below, from this segment right here, the ratio to the S&P 500 was rising. So this tells me that we were probably seeing the S&P 500 falling, but that Home Depot was falling at a slower rate. In other words, it appears that all of the smart money is coming in, liking this to pull out of this little downturn. And you can see that once the market did turn, Home Depot was overall outperforming the S&P 500. So this was an important little clue. Market prices falling, indicator rising. That's a divergence. And what that can tell you is that when the market prices finally start to turn in the S&P 500, you're probably going to see Home Depot outperform the index. And that is in fact what we saw. Now we could probably get some opposite signals down here, not real strong, but just for the video here, let's say that Home Depot is rising through here, but we see that the indicator is falling. Another divergence. This would be more of a bearish divergence. Stock price is going up, but it's not going up with the market. It's underperforming the market. And so, again, we see prices rising through here, but we also had some times when it just wasn't keeping up with the market. And so that can mean that if we get a fall or a turnaround, that Home Depot might actually underperform. We got a nice bearish engulfing candle here at the top, and when it did fall, we can see that Home Depot did underperform the market because overall we had this downtrend. So those are some little divergences you can look for that can help you with your timing for your options trades. So continue working with your price relative indicator, and you'll find that it can give you some very good insights into key turning points in the market. And again, it's because all prices are relative. If you'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and Strategy Lab at optionsa2z.com. Also, please join us on the Facebook trading group Options A to Z, and you can find a link in the description below.